Okay, here's the thing. 9 out of 10 investors will not prepare properly for 2025. And in December, they'll wonder why their portfolio got smashed up. I run an investment firm that manages over $120 million in assets and over 2,000 clients entrust me with their money. It's my job to get investing right. And one rule that I've learned is never to drive the wrong side down the highway. If the market is going one way and your investment strategy is going the other way, then newsflash, someone is going to get wiped out and it isn't the market. But what most people don't realize is that a lot of this traffic are large investment firms who control a lot of the money and a lot of the market movements. And you know the crazy thing? They actually tell us every year which direction they're going to be driving in for the year ahead. So I've read multiple of these reports and there are 5 things that every investor needs to know ahead of 2025 so they can tuck in behind these massive juggernauts and benefit from the tailwind. The big news from all of these reports is that a decade of heavy stocks growth is pretty much over. Markets are valued extremely high when looked at from pretty much every angle. Take a look at all those near 100% numbers. These are different ways of valuing companies and pretty much all of them are at all-time highs. But Mohsin, we've been here before, haven't we? Everyone says that the market's at the top and then it just keeps going on. Sure, but let's actually try to understand what has been behind this growth here. Here's a graph from Goldman Sachs that shows you where the valuation is being driven from. That dark blue bit is something called forward PE, i.e. the excitement that investors attach to the future, aka vibes. Vibes can be defined as general excitement about Trump, excitement about the future, whatever it is that gives people confidence. And now Wall Street thinks that those days are pretty much over. Sure, there will be a little more growth, but the growth will not be as meteoric as the past decade has been. Instead, valuations will be driven by the actual output of companies rather than just the vibes that people are associating with these relevant companies. If that is the case, then stocks look to be pretty well cooked right now. In fact, Goldman Sachs are attributing a 3% nominal growth per annum when it comes to stocks over the next decade. Now that's not great, but does it mean that you should completely cut all of your stocks? Well, no, stocks are an important part of your portfolio, but it is important to think about it in a wider context. So if you've already got a stocks portfolio, it probably does make sense to keep adding and to keep building that portfolio. But if you're just entering from now, then it probably makes more sense to think a bit more widely rather than just following the advice that has been prevalent over the last decade or so, which is just to go heavy on stocks. The only exception to this rule, i.e. where I personally would be pretty happy putting money, is if you're able to pick certain stocks that are showing really interesting attributes. One of the really nice attributes to look for in a company is something called free cash flow yield. If that theory is correct, then you can use that as a filter, generate some interesting ideas for companies to look at, and maybe they will reward you better than the overall market. The Magnificent 7 are the 7 largest tech companies in the world, and undoubtedly you've heard of all of them. They include the likes of Apple, Amazon, Meta, and so on. The importance of these 7 companies cannot be underestimated. They make up about 35% of the value of the entire S&P 500, which is the main US equities market. And given that the S&P 500 is about half of the world's global equities, that means that these 7 companies alone are about 17% of the entire global equities market. That is absolutely staggering. But here's the thing, in the same way that these companies were not the Magnificent 7 10, 15, 20 years ago, similarly, we expect that they will also not be the Magnificent 7 in a further 10, 15, 20 years time. So the trick is actually to try to understand what are the future trends and what are the future companies that I can put money into now that could become the future Magnificent 7 or equivalent thereof. So for my pension, I would certainly be happy to put a little bit of money into the Magnificent 7 in order to just keep building the portfolio, but I'll also be putting a lot of thought and energy into trying to identify the gems of tomorrow, because the prize is worth it. $1,000 invested in Apple in 1990 would be worth over $4 million today. So how am I finding these stocks? Well, we will do a full video to explain everything, but the punchline is
follow the rich white man.
I've looked at companies that have IPO'd in the last 5 years or so, knocked off the ones who have died or whose share prices have tanked, picked up the ones who are surviving and who large fund managers are also investing into, and simply continue that trajectory into the future. That way, as the years go on, you'll be weeding out the losers, but the ones who are going to break out and become the future Magnificent 7, you'll already have a pretty decent position in them from early on. 3 of the interesting companies that we've looked at so far are Astera Labs, Fortinet, and Nano nuclear energy. In an age where the stocks market has been growing apace, the best advice and the most prevalent advice has been to invest in low-cost ETFs and simply keep adding and don't look at it. But now if this theory is correct that the growth is slowing down, then we expect managed funds to make more of a comeback. Good examples include Saturna, Bailey Gifford, and remember that you can take pretty much any actively managed fund out there that's not Sharia compliant and use a company called Halal Invest to make it Sharia compliant. Let's just look at what Blackrock bought in the last year: GIP, eFront, and HPS. So Blackrock is literally putting its money where its mouth is and aggressively investing into what pro investors have been saying for a little while now, that private markets are here to stay and here to grow in a very big way over the next decade or so. You see, the reason that Blackrock want to buy some of these fund managers is so that they then have investment products to sell to their clients. So do what BlackRock do. Invest in private credit, invest in infrastructure. Private credit in particular is likely to grow really fast and go from about 20% of the market to around 30% of the market. Infrastructure investing in a Sharia compliant way is pretty difficult, and I'm not aware of any options that are out there right now. But Sharia compliant private credit opportunities are available. You have us, Curate Capital, Nesta, Funding Souk, Irad, Lendo, Alif Bank, and perhaps some others out there as well for you to check out. Here's something very interesting that BlackRock shared in their 2025 outlook. Their view is that private equity valuations are much lower than public markets valuations, and there's a good reason why these big private equity funds do what they do. So if you can get a slice of this action, then there's likely to be some good growth for you in the coming years. Private equity is likely to have a bit of a second wind due to interest rates stabilizing now and general favor coming back into the market. There's a bunch of deals that did not happen or didn't IPO on the public markets, and so all of that is now starting to filter through, with the big private equity fund managers able to pick up some of these deals into their funds. So how do you gain exposure to private equity as a Muslim? Well, it's very, very tricky. Of course, we at Curate Capital have pioneered our own private equity strategy, but that is just one strategy in the pharmacy space in particular. It is not an all-encompassing private equity fund in the traditional manner, but we will, inshallah, look to bring some interesting private equity deals to the market in 2025. There is some other pioneering work going on in this space in the US and in the Middle East, but the best way to stay abreast of all this information is to subscribe to our channel, because we talk about this stuff all of the time. Folks, what I've discussed here is literally how the best and the biggest investors in the world are thinking about the markets today. So all of that is for nothing if we don't actually action anything that we've discussed today. We've talked about 2 investment screens on the public equity side. We've talked about putting more capital towards private markets. We've talked about investing in actively managed public equities funds. So have a look at your portfolio today and think about what adjustments you need to make for 2025 to align with these common macro themes that the big players are all talking about. If you like this video, then please make sure you subscribe to make sure you're abreast of all things investing in 2025. Until next time, Assalamu alaikum.